welcome to the SDI investor meeting. It's a couple of minutes past 12. It's great to have Stephen Brown, CEO, and Sharma, CFO, and also James Dimitriou, the head of corporate development, with me today. And thank you ever so much for everyone for taking the time to attend. Just to highlight that SDI has made huge strategic and operational progress with a very strong team to support the next phase of growth. So first of all, we've got a question on the buy and build strategy. SDI has delivered a successful buy and build strategy over the last 10 years. Can you talk about the opportunities going forwards? And then a second part to that question, can you just outline how you are encouraging closer collaboration between the underlying businesses?
Yeah, of course. SDI has been very successful, as you say, in buy and build up until this point. What we have done is really taken this to the next level. And I think that's an important point to note, in that we've made it very clear that the business is very much split right down the middle. So one half is organic, the other half is inorganic. And what we have done is that maybe it's a little different to what the SDI used to do, is that we've now got equal focus on both of those, because we realised the importance of the organic side. The organic side has to be profitable, has to be cash generation, and has to grow. So what that does is with a focus on cash generation, you've got the circular impact feeding the inorganic side of the business going forward. And really with having, because we are a buy and build business, without acquiring businesses, that doesn't happen. We're going to essentially stagnate. So the importance of really having that, growing that inorganic side is just as important. So we've got that closed loop. Also from the inorganic side, we put more emphasis on how the acquisitions come into the group and benefit the organic side. So you've got this circular motion coming into play. And that's something which us as an SDI management team have really focused on. I think really the first half of the year and the second year, and we're starting to really reap the benefits of that. So in terms of the inorganic side, thanks to James, we have built a very strong digital process. That has led to a very strong digital pipeline. That's sort of sitting around 35 businesses at the moment. And we obviously shortlist this the whole way through. What we typically do, we've got multiple deals on process at any one time, so that because we understand the propensity to fail during an M&A process. Something else which is probably worth pointing out as well is that our DD is a lot more robust than it probably would have been before. Where that robustness has come in is mostly in the CDD side. So the FDD is equally as robust. The LDD is also equally as robust, but where we've really boosted it, where there's really the strength of the team you see in front of us, is really bringing in that CDD.
Commercial.
Yeah, thank you. I'm really, where we're really seeing the benefits of that is we really understand the markets. We understand the market fit, but we also understand the dynamics of the individual business that you're acquiring at the same time. And what that's actually doing is giving us a much stronger value proposition when the business really comes into the group. It makes it a lot stronger, a lot more robust. We're quite proud of the fact that we've just recently walked away from an acquisition. And that was very much at the next stage. It was in the SPA phase, and we walked away from it because there were red flags which we were not prepared to expose SDI to. So we walked away from that, and we will do that again. And I think that's really important.
Yeah, thank you. Thanks, Stephen. So the next one, probably for Ami, are there any larger one-offs going into the second half that will make the comparison base more difficult?
No, I think the SVS item I highlighted in the comparatives for the first half was the main first half, second half oddball, if you like, in terms of weighting, because in terms of the comparison. So no, there isn't anything in the second half of FY24 comparative-wise that will make comparisons difficult. No.
Tessa, if I could just jump in, I'm just reminded I didn't fully answer the previous question, so I missed out the synergies portion. So within looking at, I talked about the two halves of the strategy, so let's focus on the organic side. The synergies across the portfolio of businesses is something, again, which is relatively new to SDI, is something we've been focusing on. So we've now got ahead of organic growth as well, which James's counterpart. And what we're looking at is how the businesses can work together where it makes sense. We are a very lean light team, and we will continue to be so. But nonetheless, there's a number of synergies which we can really take hold of, and that's really looking at benefiting from economies of scale. You've seen the Lab Innovations Conference. That seems relatively insignificant, but it's a very big deal for SDI because it's never been done before. Whereas before, we took a very influential expo, and SDI group businesses took small parts of that show. What we've done this time is actually dominate the show. So we've taken the biggest stand right in the very center of the expo. So it's got the draw, it's got that visual impact. And we're now actually co-exhibiting as a group, so that where people can actually look at, they're taking they can take one piece of equipment. They also see the crossover of another piece of equipment, another piece of equipment. So before we know it, we're actually taking a much, much larger piece of the lab equipment pie, which is what that is. We've also got businesses within the industrial scientific product side feeding in to the lab equipment side, and vice versa, is going back and forward. So really the whole synergies piece is a significant focus for us.
And then Synoptics are white labeling LTE products to sell on. So we're seeing the cross-selling opportunities increase, and that's a recent development which we're going to see more of. We've got LTE manufacturing for Safe Lab. So there's a whole heap of stuff happening particularly in lab equipment, which is driving with the collaboration driving increased sales, and you're going to see the benefit of that in the next 18 months.
And are you starting to see any of these synergies actually drive any margin improvements or any increased sales revenue?
Well, the cross-selling will drive sales revenue. It's going to be modest to start with, I would say, in this financial year. I think the benefit really will come in the years in 26 and 27. Don't ask me to quantify it just yet, but it's modest to begin with, and we'll work upon generating more. In terms of the margins, yes, you will see all of what we're doing is really margin enhancement.
And you could see our margins have improved, and where that improvement is coming from several functions. Not only is price increases, it's starting to filter through, and we're trying to benefit from that, but the efficiencies bit is really driven by those synergies.
So the margin expansion will come particularly in the lab equipment, and the revenue synergies, if they're going to, they'll come in all divisions, but particularly in lab equipment in the years to come.
This is probably slightly a trickier one to answer, but what further comfort can we get on the ability to hit FY25 forecasts given the H1, H2 split? And did the order book as at the end of October give you similar levels of cover that you've seen in past years?
So as it stands, we're working very hard to deliver our FY25 numbers. And until we say otherwise, that's where we're going to be. We still expect to do so. So our order book is 3 months of sales typically. So we have a short visibility typically. At the end of October, we had about the 3 month order book saw us through to January, and we were happy with the sales forecast to deliver that. And I can say that at the end of December, the same for the 3 months thereafter. So the order book is holding up, and it's an improvement from where we were, I think, at the end of FY24.
I've got a few questions now relating to the strength of the order book and more on the length of visibility. Is it strong across the three segments? And can you maybe give a bit more detail on the drivers of that?
Yes, I mean, in terms of growth on the FY24, which is really where we talked about previously, the sensors and products were, particularly strong. Do we have any more visibility? Some of them, you see, the thing about the order book, when you get to that level of granularity, is that different businesses have different cycles. And you've got Fraser, who have a 2-week lead time, so won't be able to tell you. We'll have a very short order book, and then you'll have someone like SVS, which have an order book which will last a year and a half. So it's difficult to talk about generalities, really, when you're talking about the window. The lab equipment order book did fall off, which is what at the end of FY24, which is why we saw the weaker sales in the first quarter. So I wouldn't say the order book has changed significantly beyond that in terms of how far we can see, but in the wash, what we could typically see is 3 months forward, and that's, and I wouldn't want to say it's any more than that It typically is 3 months forward.
And now I've got a question just touching on China. Are you seeing any further weakness there? And will this market be much of a focus going forwards?
We as a group typically stay clear from China as much as we can. We've only got 2 or 3 businesses currently really seeking any significant revenue from China. The biggest one is Fraser Anti-Static. Fraser Anti-Static sell through a joint venture, which we part own directly in China, so we do have control of that. Fraser Anti-Static China is actually doing particularly well at the moment because of the markets we currently sell into, and because we're classified as very much as a consumable going into China. And we're not seeing any significant fall off there. In fact, it's going quite the other way. Our other businesses operating in China, the other notable one is probably Synoptics. Synoptics did see a fall off, but it's picking back up again. But it's really a relatively insignificant factor into that business anyway. So China's not really hurting us. In fact, it's helping us from a Fraser standpoint.
And just on geographic expansion, can you talk about potential tariffs and the new business in SpecVision if you're seeing it as a potential hurdle? And also what you can tell us in terms of opportunities for geographic expansion and how you'll go about this?
Yeah, of course. Whenever we talk about tariffs, of course, everyone's talking about the US and what President Trump is really going to do next. And if anybody knows what they're going to do next, they're certainly a lot smarter than I am. But really looking for, we have been preempting a change in the US for quite some time, even before Trump really was president-elect. So we do have a US strategy of how we're going to go after that. So we do have a strategy of how we want to do more domestic manufacturing and supply for several of our businesses. We've had a plan in place for Applied Thermal, for example. We've also looking at a few other of our businesses as well, going into the US, like LTE and Modern Scientific, for instance. So we understand what's going on at that. SpecVision is a very good point, where 60% of their products do go to the US. That's via the distributor. The good news is that it's a very controllable end user market, which they're currently selling into. If it really needed to, the hardware could very easily be produced in the US, and there are discussions going on with our distributor doing the best of the machine there. At this point, it's probably not worth it, because the value add of that particular product is the software side, and really that's not going to be particularly impacted by the tariffs. So we're not that worried. But really looking at the US, we do have a side strategy going on beyond that. They've got international reach that feeds very much into our organic strategy. You can see the acquisition of SpecVision. That was one big tick in the box for acquiring that business, was the international reach. So that the amount that SpecVision sells domestically is completely insignificant. It's single figures in terms of percentage. And that was quite attractive for us. SDI as a group, really, we know where we need to get to. We know the levels of growth that we need, and we know that the UK is probably not going to give us that. So really looking at that through international exposure is very important to us. So really you'll see on the inorganic activity going forward, international markets is going to be featuring very heavily in that.
And of course, as of today, there are no tariffs from the UK to the US as of today, but of course, we don't. No one knows what knows what Trump's going to do.
So it's all about future proofing. We've also now got 2 international entities, which is quite useful. So we've now got a business located in the EU, and we've now got 2 businesses located in the EU. So Ada Cameras is now almost a sole Portuguese business, which is going to help us as well from an EU standpoint. And also SpecVision is also a EU business also. So if you think about international expansion, there's 2 straight away which have come in this financial year.
Now, just looking at momentum again, you mentioned trading has continued strongly into H2. Is that sequentially month on month?
Yeah, I mean, December is always slow. December is always a quiet month. So it was November we were talking about, and now we're into January. We haven't seen the January numbers yet, but we know that is stronger than November. So yes, it has continued. But December is always a quiet month, and it was particularly quiet this year actually because of the way the dates fell, which means that the January will be stronger. But we haven't seen the final January figures yet. It's still too early.
And can you give us a sense of how much business is recurring revenues versus sort of one-off capital equipment?
We've done work on this in the past. It's circa between 15 and 20%, which is recurring. The rest, we're working very hard to increase that through servicing business and so on, but it's between 15 and 20.
And we've seen generally challenging, tougher trading conditions sort of across the board and from some of your competitors. But out of your portfolio, where do you see the most growth coming from, and what are you doing to address the opportunities?
It's a good question. So it's something which I mentioned earlier. It's part of the resilience of our current portfolio. Some of our peers did see really tough times, particularly in the life sciences industries, and being quite honest, we have as well, as Amy mentioned. On the lab equipment side, our order book was quite challenging going into the beginning of the financial year, and that contributed very heavily to our H1, H2 split going forward. What we did do is we seen those markets challenging, so we pivoted very quickly and very much focused on the industrial and scientific product side, which really held us resilient, particularly well, particularly with added cameras, for example. Fraser also held us the strength and really focusing on those and making sure that the robustness was there, waiting for the life sciences to really pick up again. We knew it was going to pick up, and it has. It has done very, very strongly as well. So we hedged up well. So really going forward and feeding into, and I'll keep referring back into this, is that we've got this circular movement, circular motion within SDI, is that whenever we look towards the inorganic growth as well, we're going to be looking at businesses within sectors which is going to improve our resilience, improve our robustness going forward, to really, because we know that markets will continue to throw rocks at us. But we know that that's a given going forward. So it's really within our gift to improve the robustness.
And just looking at cash flow, you've had a very strong track record in terms of free cash flow, and it's really good to see the improvements that are coming through after the recent destocking. Can you say any more on your acquisition strategy? You successfully funded acquisitions out of cash flow. Do you see any change to the strategy going forwards, given the current balance sheet and the type and scale of acquisitions you're prepared to make?
We generate around circa 5 to 6 million free cash flow. The good news is cash has been good in the second half so far. Well, we'll say that, and so we're still confident of delivering good cash flow. I think our strategy has been to keep our leverage between 1 and 1.5 times, and at the end of last financial year it was about 1.1 times. And what I've said is that we can self-fund their acquisitions circa 6 million, and that could generate anywhere circa 1 to 1.3, 1.4 million of EBIT per annum, depending on scale and multiples, of course. But and we can continue to do that really, and we can live within our means.
We've closed the speculation, and we've still got five power to keep going. The dig flow is really it's not stopping. In fact, it's hopping up. So we're certainly far from that.
And our continued cash generation allows us to do that. So we're still happy in terms of cash wise.
And could you give a bit more colour on cost cutting and investment in the business and capex?
Yeah, in terms of cost cutting, I think we've done some restructuring. Attic, we restructured, as I've mentioned, where we, in essence, moved that business to being a Portuguese-only business. We've closed the Norwich business. We're about to close it.
Yeah, so Attic was structured in such a way that manufacturing purely was done in Portugal, and the head office and R&D was done in Norfolk in the UK. We've changed that. We've done, and this is just one example. We've done this in multiple businesses where we looked at the cost base of that business and we rationalised it. So what we have done is really it didn't justify having those two facilities, because essentially doubled the cost base, and that's exactly double. And so what we've done, we've taken the Norfolk facility out, and it's now purely a Portuguese business. we're looking at mum, let us say, if I haven't talked before. So we're doing some significant cost rationalization there.
And the Synoptics Inc. we closed down, of course, which was, as Steve mentioned and I mentioned earlier, and that resulted in the cost saving too. So there is plenty of cost saving going on, and we are very much monitoring our headcount very closely, and with the increase in NI as well, that's particularly pertinent going into next year. In terms of capex, nothing new to report there. We circa spend around 1.5% to 2% of revenues on capex, and this year will be no different. So no significant capex planned or was never budgeted for. Actually, we knew that we would have a heavy capex year, and so it's transpired. And along the term, we still see around 2% of revenues as being our capex requirement. It's a light asset model business.
And when do you expect business growth to re-accelerate? And in particular, when did life sciences start picking up again?
Good question.
Yes, indeed. So I'll say the latter first. The life sciences it really picked up during the first half. So we're now reaping the benefits into the second half. Hence the H1, H2 weighting. So life sciences does seem to be picking up. Is it right back to where it was before? No, but it's pretty damn close. In terms of acceleration, we're being very transparent in terms of what we're doing. We've not got a really clear strategy, and we're just going to push that strategy like hell to make it effective and make it work. We're already starting to see that the benefits of that going forward. It has been a tough year, but our resilience is really down to us holding that course and understanding where we're going and really keeping moving on that. Where we're going to see acceleration really from now onwards. We're really hoping that on what we're saying, next financial year is stronger and it's just going to keep on building. This is what we're currently saying, but it's all for us to deliver and also just hold the course steady.
Just related to that, do you think that next year the existing portfolio can generate growth of between 5% and 10%?
Next financial year, we're not seeing any reason why not. We've got strategy, individual portfolio level strategies for each of our individual businesses. Really, we've got good expectations of what business is going to go where. With a diverse portfolio that we've currently got, as you'd expect, there's quite a significant range of predicted growth levels within each of the businesses. Some of them are very low, but they're highly profitable. And some of them are sort of much higher and well in the double digits. So really, whenever we talk about organic growth, what we're looking for is an average across those, which given there's 15 businesses, it's very much a moving target. But really heading those levels of growth across the portfolio really should not be much of a challenge given what we're putting in.
And just on the margin, what's the sort of longer term sustainable margin target?
Yeah, so it's I've said this before. It's one of the hardest questions anyone can ask me is what the margin target is, because it can be skewed by individual contracts. I mean, I think many of people listening in will remember the COVID contracts, which skewed margins because of the drop through in one company to above 20%. I think today where we are, circa net operating margin around 14 to 15% seems to be about the sweet spot for the mix of businesses we've got. But that can change very quickly with one big contract in one company. But I think that's as a group is constituted today, I reckon around 14 to 15% is the net operating margin in the long term.
And are there any other big operational changes we should expect, or changes in the management structure?
We've always been quite transparent in terms of how we operate the SDI group. SDI as a team is a very lean team, and we continue to do so. And be so. So what we are very much beholden to is the quality of the leadership of the portfolio businesses, and that's something which we continuously monitor and measure going forward.
Yeah, at the PLC level, we'll probably stick to about 5. The headcount's 5, and I'll stick with that.
We're likely to stick with that. It's on a portfolio level. where there's going to be very much a moving target.
And are you happy with the structure in terms of managing the operations and driving the growth by acquisition?
That really, it's really the PLC team we've currently got at the moment. We are light. We do run very hot. In terms of skill set and talent, I think we're in a quite a good place right now. Could we do with increasing and beefing it up? Yes, we could. And I think as that critical mass, as the profitability of the group grows, we may look to strengthen that. We would like looking at the structure across the group. So we've got the 3 pillars. Really, there's opportunity there, really driving potential leads across those pillars going forward. So that's something else we've got in mind as well. So really, we know what we're going to be like whenever we get there. It's just really driving that journey to get there. So I think, again, that's going to be a moving target in terms of that.
And can you say any more about the M&A opportunities and sort of your EBIT multiple targets for buying acquisitions? What's the competitive landscape like? You said you walked away from one recently, but are there a lot of opportunities in the pipeline?
Yeah, over the last 12 months since I joined last May, it's been very much about building that pipeline and strengthening the relationships we've got with that. Of course, as anyone knows, with M&A, quite a lot of transactions that we've been doing at least, we've built a strong relationship with the management team before we've even got to a point of acquisition. So we've now got to a point where we've built a plan for the next 3 years, identified the targets that we want to look at, and are all happy with the way that they are built and the culture that they have. So we've very much got this momentum now of looking at these companies to move forward.
In terms of the multiple, we're still much the same as the range as ever talked about.
I'm conscious to not mention ranges because when we then go for an acquisition, someone says, "Oh," but I think it stays similar. Everyone's seen our previous acquisitions, so I think it's within that range. Yeah.
And I think you've talked before that there are significant benefits for companies joining SDI. Can you just outline why companies would want to come and be part of the SDI group?
From a targets point of view, we're always keen to have the management remain involved, and quite often other acquisitive companies would want to change up the management, potentially break down the company or absorb it into one of their own portfolio companies. The feedback we continuously get is that they're happy with the culture we have, the community we've got with all of the MDs, and the fact that they remain autonomous, essentially, with the support that we can bring to them. So they could focus on the sales and growth of the businesses.
I'm conscious that we're approaching the hour and we've had quite a lot of questions. I'd just like to thank Stephen, Ami and James for their time today, and everyone that's joined the presentation. We had a number of different questions. That was very good. So thank you again for coming and presenting, and thank you for everyone that attended today. That now closes the webinar.
Thank you. Thank you.
Thank you.